So thank you very much for joining us today, Chris.
No problem.
So perhaps if you could tell us a bit about, exactly what you do and what the Financial Services Club do.
Well, the Financial Services Club is a networking group for people in the banking markets across Europe. And we meet in London, Edinburgh, Dublin, Vienna and various other cities on a regular evening basis just to network and develop our knowledge and relationships across those markets. It covers retail, commercial, investment banking, and I blog every day as a result of that on a blog called thefinancer.com, talking about all aspects of banking with tongue-in-cheek.
I had noticed that was the very next thing I was going to talk about, exactly that. You are an avid blogger, I would say. And I was reading your post, I think it was it was from Monday, but from Sunday when you were on the BBC talking about taxation issues. And I thought that was a very particularly interesting post.
Well, it's just a debate that we were having on Sunday Morning Live, which is a BBC programme, about should we tax the rich more? And obviously, as a vote, people said yes. 84% of the people voting said yes, we should tax the rich more. But then the question is, who is rich? How do you define what rich is? Is it disposable income or income earned? Is it based on wealth? And then the key point for me is that if you tax the rich more, it's just a stick, and as soon as you start hitting people with a stick, they disappear. They don't like it. So it's much better to give them carrots. Therefore, you should incentivise the rich to give more tax by allowing them to self-direct where it's placed, such as if you support education, you put your tax into education and say that's where I want my tax to go.
And even if you do have less people overall paying that tax, you're talking about a large, so more people paying a smaller amount, then you're talking about a much larger pie that you're taking a slice out of, as opposed to shrinking that down and taking a much bigger slice out of it, which actually doesn't add up to nearly as much overall.
No, I mean, at the moment, if you tax a rich person at 50% and they earn £1 million, then you've got £500,000. Whereas if you tax the same for a £100,000 earner, it's £50,000. I'd rather have the 500,000 because that's a bigger slice of the pie, as you said. Right now, a lot of jobs losses in the city, about 15,000 this year, representing a £1.5 billion loss of income tax to the government, plus all the wealth that goes around that in terms of employment of those people with other people. Equally, as we talk about bankers leaving the city to go into Geneva or Hong Kong, same issue. So the government's got to be very careful about how they hit that tax pie and how they deal with it.
Absolutely. And you were talking before about, yesterday, about the markets being landmines.
Yeah, the presentation I gave in the opening of TradeTech Architecture was all about how landmines and banks are very similar. The reason I use the analogy is that the Financial Services Club supports a charity called Mining Advisory Group that seek out landmines in Libya, Somalia, other countries. They use mice to find them. And once found, hopefully you don't find dead mice, you find a landmine that you can then take out of the ground and clear and enable schools and freedom of movement. In the capital markets, and in particular in the financial markets of the world that are now very complex, globally interlinked, lots of counterparty risks where we don't know what our risk exposures are. By way of example, the Financial Services Club did a survey just in the summer, and we found that only 1 in 10 banks know their liquidity risk in real time with their counterparties and with their overall derivatives operations. So that's bad. And what we're trying to say is you need more real-time dashboards, risk analytics, mice, but electronic mice, to sniff out the landmines in the financial markets. And the people like Kweku Adobu, who was the guy from UBS who blew up, like Jerome Kerviel, large risks. You need much more systemic risk controls, much more mice in the system.
Just finally, one more question. Of course, everything here, we've been talking loads about high-frequency trading. Do you think it's one of those things, as some people have been saying, that is actually eventually going to be unsustainable and in a few years' time may not even exist in the way that we know it now?
No, I disagree completely. And the reason I disagree completely is that we've gone down this route of high-frequency trading, low latency, things getting faster and faster. There is a place for that, and I think where we end up is the place is that it's a platform, it's an infrastructure, it's a networking capability that does nothing other than provide the ability for those who want to place orders into those systems, which will typically be hedge funds, private equity, day traders, buy side, sell side. They should be able to do that, and they will continue to do that. And the whole discussion around transaction tax, for example, I think it ends up saying you can only tax filled orders, in which case you still get all of the latency and speed and volume that we currently have in HFT, but you just tax on the transactions that are filled.
So, unfortunately we are out of time, and just so people know, we are going to be having some fantastic guest posts from Chris Skinner on the TradeTech blog, but if they want to read the thing in full every day,
thefinancer.com.